Hey, this is Macro Atlas, and today we're going to be discussing the rejection at the bull market support band for Bitcoin. So I had posted a video on this 3 days ago when the rally was heated, and sure, there was a high chance of seeing some kind of resistance there, and we did see that. So in this video, we're going to be discussing what are the factors that we should look for to determine if there is, in the microstructure, is there strength to break above the next resistance level, which sits at 85,000, or do we actually see some more weakness and break down to the range low at least? So before we start, I'm Mo. I'm a crypto and macro markets speculator, and I've been a speculator for the past 5 years. Um, so yeah, if you enjoy this video, please leave a like and subscribe, and let's drill down to the factors, the microstructure and the fundamentals that are driving price. So in the previous video, we did discuss the possible rejection right there, and we said it's highly likely because recency bias can play a part here, and previously we had been rejected from there, and in the previous bear market as well, we had seen something very similar play out here. However, in the previous bear market, we did extend above the bull market support band and then went down, okay? So it's also possible to see some strength build up above the bull market support band and then see some weakness back down, right? So I can see three scenarios right here, and we're going to discuss them slowly. One possible scenario is just do that, consolidate under the bull market support band and head down, at least to the range lows. A second one would be break above it, make a fake out, like we did in last bear market cycle, and then drop down. Maybe let's do the 1 day better. The third one would be actually to break above and test the range highs of the consolidation period, right? So we'll probably see some kind of resistance at the next resistance level. Now, I'm leaning more biased toward that Bitcoin actually sees a rejection here and continues to the downside. And that's mainly because oil has seen a nice rally, and rising oil is bad for risk assets such as Bitcoin. Okay. Why is it bad? Is because, well, if the oil rises in price, then inflation expectations go higher, uh, interest rate odds go lower, and then you start to see the effects of oil prices on headline and core inflation 2 to 3 months after the fact, which should be the time now. So it's TikTok. Of course, we have seen a major increase in core inflation, right? Sorry, headline inflation. Yep. So the rising oil prices very quickly trickled down to headline inflation. It usually takes a month or two lag from core inflation to head to headline inflation. So I don't believe that this spike was mainly driven by higher oil prices, but rather of other macro fundamentals. I believe that oil prices will be reflected in core inflation, maybe in the next data print. All right. So that's reason number one, fundamentally speaking. Two is recency bias. Okay. We are in a bear market, and the last bear market, we had seen a rejection at that level, and we had discussed why it is very similar, the current consolidation phase to that phase. Okay. Some similarities we can see is in the microstructure of the price. So if you check here, we did one relief rally, a second one, and surely maybe just lock that one. Does that lock down? Let's see. And surely a third one. No, it doesn't. Yeah, that one. Yeah, so that's one similarity in microstructure. And notice how the last one had actually been the one that went beyond the bull market support band. So that's also very relevant. In this market rally or consolidation phase, we have seen one rally, a second one, and then of course a third one that reached the bull market support band. So in terms of microstructure, things are winning for the bear sides. Okay, possible rejection here, there. So there's some kind of, it's going to be in the trader's mentality that, yeah, we got rejected there, so a lot of traders going to take advantage of that opportunity. Second is, well, there seems to be some sort of decline in the strength that Bitcoin is having during that rally, and you can see it because we're having that kind of like mountain-shaped upside. Where we see that is actually in the stock market very recently. It's a very known bearish pattern that shows signs of distribution. So it's one of the clear signs of distribution. Buyers are trying to buy it, but sellers are just selling it whenever they hit those thresholds, right? So like it would be around there. Yeah. We have seen that in the S&P. You can see that it is a mountain-shaped slope, and then bam, all right? Sometimes go down more slowly, but this one was like bam, all right? The second one is also like that from the bottom side, and that plays out again and again in history. And the most, I'll say, referred to one is the dot-com bubble, all right? I like taking patterns from history because they usually do play out in nice ways, right? So if you think about the microstructure, this is the things that matter to me. I do not really take into consideration so much of the technical indicators. I care more about volume, volatility, and microstructure. So volume is that basically, and I like to use the volume candles as well. Microstructure is the price pattern and the patterns we make and the price candles and stuff like that. And volatility is just, I use the VWAP, all right, it's very nice. And I'll show what's the VWAP referring to Bitcoin right now. So yeah, in the dot-com bubble, we had seen something very similar, like that, mountain shape, and then bam. So it leaves you to wonder, while the stock market does that on a larger scale, are we doing that on a smaller scale for Bitcoin? It would make sense in some ways, as the market is related, and when such patterns play out, they are, this pattern, in my opinion, is pretty predictable to some degree, probabilistic view. But of course, it could revert back on any news. All right. The third microstructure thing I would like to point out is the 3-day candle we just printed out right there. So anything with wicks, that usually means short-term reversal. Okay, short-term reversal means maybe like that and that, right, and then we go up, or that and that, right, or just down and down. The 3-day is not good to draw with. And I'll give you some examples. If we maybe go to the daily, you can see such things play out as well on a smaller scale, like here, here. This was seen on the 3-day, which is a higher sign. I like the 3-day more, of course. Here we've seen on the 3 days too. We can also see it in somewhere here, right? There, played out, short-term rally. There, short-term dump. There, big-time rally, dump, sorry. And there, of course, one of my favorite ones. That was one of my signs to say to determine that, at least for myself, that the next leg up is building up from that, right? I really like wicks. I like to see them. I like to trade them. Oil did it recently. I mean, I've opened both long and short positions at different times because, well, not solely because of the wicks, but they are damn good sign. So here, that was nice short place. Here, nice short place. Here, nice long place, and I actually took that long. So now I close my position for oil around here, not fully, but I think we might test those ranges. So just see what the other candles play out, like what happens here. We will drop another video on oil discussing all this. So if you're interested in oil, and we talk about hopefully soon about gold and the stock market on this channel, we're not just a Bitcoin channel, even though my main trading asset is Bitcoin, and it has been for the past 5 years. But I'm expanding my venues, so I'll also deploy more videos on that. Speaking of the VWAP, if we go maybe to the 3-day, okay, we're gonna delete that. I'm gonna get another VWAP that is already configured, and I'll give you a very nice tip on how to time the market. So a lot of people believe that timing market is difficult. Well, it is. It is. It will take a lot of experience, but timing market is not impossible like many traders say it is. If you really read about or listen to the top traders in the industry, whether quantitative, traders or discretionary macro traders, they both, their edge, it comes from just timing the market. Yeah, printed here. VWAP, yeah. And the VWAP really helps me all the time. Try to catch the right moment at the right time. And I'm not saying I'm perfect, right? Timing the market is difficult, but it is possible. And it's not difficult because of why people think, all right? A lot of people can actually say, oh, feels like the peak, and it turns out to be the peak. And they're like, oh, I should have sold, but then they would lose money again when they start trading, and they do not have so much conviction about their theory. Timing the market is difficult because controlling emotions is difficult, and trading just at the right time is difficult when you have the highest conviction possible. For example, I usually would time this here. I'll write it down, and then I'll just keep adding to my position, and then I would add here, and then the price would rebound, and I would lose a lot of my profit just because I added here. But I timed the market correctly, but I still, well, sometimes lose money, but sometimes not make a lot of money because of some mistakes I make, right? So I made rule for myself. I made a rule for myself to actually be able to better time the market. And if I can find that somewhere here, okay, no, we can draw it on the previous chart. Sorry, a lot of charts, it's a lot of analysis. You gotta study a lot, right? This zone for me is noise zone now. I do not trade that zone, and I would even extend it to here. Because whatever happens there is just very choppy. But if you can catch the range highs, right, and the range lows, then you have much higher probability of succeeding on your trade. Or if you're trying to trade, for example, a long position, then if you want to go long here, I don't believe going long here is really the best choice. I'm bearish on Bitcoin right now, fundamentally, microstructure-wise, cycle-wise. I would not take a long here, but talking about getting short Bitcoin is pretty unpopular, so we're gonna try talk about longing Bitcoin from here. Okay, because when I say short Bitcoin, a lot of people are like, I'm gonna leave the video. All right. So what I would do here is, for example, I would long here, and then I would wait for the breakout, right? The breakout of that thing, I would add to my position. I would wait for confirmation of expansion, and then, for example, you can add to your position here. But that phase right there is just pretty dangerous trade. A lot of things that happen to traders is death by 1,000 cut, right? And the death by 1,000 cuts happen in that orange zone. A lot of the profits that you make on the expansion phases tend to go away in those phases if you're not careful. So for a successful market speculator, making gains through trading is not about your trading. All right, you're gonna probably be in a trade depending on your time frame, but I would say 20% of the time, if not less. As Jesse Livermore says, one of the greatest market speculators of all time, and he killed himself because, well, I think got stressed a lot from losing money and making money. He was the boy plunger, so he was pretty aggressive in his trading. He would go all in, and when he's wrong, he gets blown up. But when he's right, he becomes a millionaire. And that happened to him 3, 4 times. I guess that really put toll on him. That's why really trading is all about risk management as well. First, we're gonna discuss the point on what he said is. The first point is that you make more money not while you trade, but while you sit. He always says, it's not my trading that made me my money, it's my sitting. You heard that? It's my sitting. All right? If you read his book, that rings like a bell. And then you start to notice that majority of the time, you're not going to be trading. Majority of the time. Successful trades come right at the right time. Right at the right time for a short period. For example, if you're trading that time frame, previously I would trade whole cycles, so a few years, but now I trade a few months. And that's usually the progression of traders, right? Some of them start from very little and then they find really good middle ground, and some of them start with years and come down to middle ground. So I don't know how you want to think about it, but it's depending on, are you doing bottom up, which is microstructure and usually is short-term time, like scalping and daily trading, or are you doing, I forgot the other one, bottom up and, well, top down. Yeah, top down. Top down is like a micro view, which usually expands the horizon and makes the time frame a little bit more longer. Well, I started as top down, and right now I'm mixing top down and bottom up. So I found that being in the market for a long time was difficult for me. So going through those periods was very difficult. Going through this phase was extremely difficult, and that phase was pretty volatile. So when I started buying Bitcoin was around this range, right? Here it was pretty fun. You write it up all along, and then you think it's gonna stay like that all the time, and then and then you get that. So you're like, oh my god, that's awful. And from that, I learned that maybe it's better just to switch the trading style to take the expansionary phases as such. And in previous video, we actually built a whole trade thesis on that move right there, and we successfully captured it from top to bottom. And yes, we might have thought that the breakdown will happen here, but we got it correct, and we got the exit exactly correct, which is spectacular. I would not hope for better than that, right? Also for the oil, we've spoken about it. I mean, it was highly probabilistic. Well, we said we're going to get the rebound here, but we did get it here. And I'm going to release the next video. We talked before the rebound even why the price might see some huge resistance at 120. I'm going to release another video soon about why we will see resistance at 20. And spoiler alert, it's about policy-driven pullbacks. So artificial calming down of oil prices so that world economies do not get hurt, and governments are doing that, like aka America, which is good, I guess, if we reduce the effects of higher oil prices on people's lives. And that's I think that's a tradable thing, and also it is I believe it has some good verdict behind it. So yeah, in terms of microstructure, we're having some wicks. We got rejected of the bull market support band, and also, of course, the VWAP compressed. When the VWAP compresses, that means usually there's an extension leg, either to the down or up. It doesn't say the direction, but it says volatility has compressed and is going to expand. You can see it compressed here, and it expanded downwards. It compressed here and expanded downwards. It compressed here and expanded upwards. And sometimes, just so you know, sometimes it compresses and it means more consolidation, but that rarely happens. I think like around 20% of the time. Here, it could mean maybe consolidation, and usually the consolidation period after that, compression of volatility, approximately matches the period behind, right? And we can see that even in that zone here. Just as a case study, it approximately matches it, right? But more often than not, it means trend continuation. And sometimes we compress, go up, psych people, confuse them, and then we actually go to the direction where the least line of resistance goes. So where actually the fundamentals and the macro points. And right now, with interest rates being steady and oil prices going higher, there's one thing that is for Bitcoin, and I believe this is why this rally has been fueled, is actually the increase of the balance sheet of the Fed, right? So just saw that one, and we can conclude. But it's important that everybody knows the government is increasing liquidity in the market, so please be careful when you're trading. There are some factors pointing downwards, but this one important factor is pointing upwards. The Fed balance sheet is increasing anytime soon, loading. And it's mostly, so they are increasing their assets and they're reducing their liabilities. And when they increase their assets, right, so that's the Fed liabilities. Oh, their liabilities just went up since last time. Oh, damn. Okay, but the total net liquidity just dropped. Oh, that's bearish for the. We just. I haven't checked that in a while, but the thesis a little bit changes about the bulls. So usually when the liabilities are going down, that means liquidity is increasing. Of course, that has to be also in balance with the assets going up. Okay, so right now the assets are still continuing up, especially the treasuries, but they are offsetting that by increasing their liabilities. So for liquidity, they both have to be in opposite direction, and the assets has to be up. So you can see this is not the official metric of net liquidity, but a lot of traders use it. It just basically subtracts the liabilities from the assets and sees the verdict of the liquidity that is being injected. Is it up or down? And right now it's actually down. So liquidity that has been added since we've talked about it last video, which is maybe just a few days ago, just dropped quickly. And that's something we should definitely track more. Because if net liquidity continues trending down and we break that support we have, then it's bad news for the bulls, and there's even higher conviction that we're going to get pulled down here. But till that happen, the confirmation of the liquidity, we might actually be higher by then, and then see that. Who knows what the market will do, but this is my view on the market. I do hope you have learned something, and if you did enjoy the video, please like and leave a comment and subscribe. I will see you in the next one, and please trade safe. Peace out.